Imagine dozens of supertankers, each carrying 500,000 barrels of crude oil, just sitting. LNG carriers worth billions, fully chilled and ready, with nowhere to go. Coal bulk carriers circling aimlessly off Chinese ports. This wasn't a hurricane. It wasn't a pandemic. This was June 2025, the month U.S. energy exports to China effectively went to zero. Not a slowdown, not a dip. 0 barrels of crude, 0 cargoes of LNG, 0 meaningful shipments of coal. For the first time since the shale revolution turned America into an energy superpower, the world's largest importer simply closed the door. And the most alarming part? China didn't panic. It barely blinked. This is the story of how, in less than a year, one of the biggest trade relationships in global commodities collapsed, and why many believe it will never fully return. Rewind to 2023 to 2024. The U.S. was riding high as the world's top exporter of liquefied natural gas and a major crude supplier. China was the prize, the fastest-growing energy market on Earth. U.S. LNG exports to China peaked at over 12 billion cubic meters in 2022 under long-term contracts. Crude oil regularly topped 300,000 to 400,000 barrels per day during friendly periods. Coal and ethane rounded out a trade worth $30 to $50 billion annually. Then, almost overnight, it was gone. Chinese customs data from 2025 tells a brutal story. March 2025. No U.S. LNG cargoes discharged. June 2025. 0 barrels of U.S. crude imported. Mid-2025. U.S. coal imports fell from hundreds of thousands of tons per month to a handful of symbolic shipments. Bloomberg called it one of the most abrupt trade blackouts in commodity history. Reuters described it as the end of an era for U.S. energy exporters. It didn't happen by accident. The collapse began with liquefied natural gas. In early 2025, Beijing raised tariffs on U.S. LNG in stages, eventually pushing duties so high that even America's ultra-cheap Henry Hub gas couldn't compete. Chinese buyers didn't fight it. They quietly stopped nominating cargoes under 20- and 25-year contracts signed just a few years earlier with companies like Cheniere, Venture Global, and Sempra. Terminals along the U.S. Gulf Coast, Sabine Pass, Corpus Christi, Freeport, suddenly had tanks full and no destination. Force majeure declarations piled up. Lawyers got rich. Tankers sat idle. Crude oil was next. Russian oil, already flowing at deep discounts after Western sanctions, became the default choice. Urals crude traded $10, $15 below Brent, an offer Chinese teapot refiners couldn't refuse. Add political cover from Beijing, and U.S. grades like WTI Midland or Mars suddenly had no buyers. By summer 2025, not a single VLCC loaded with American crude was heading east. Coal followed the same path even faster. From regular purchases of high-quality Appalachian and Powder River Basin coal, China flipped almost entirely to Indonesia, Australia, when relations allowed, and Russia. Here's what made this different from past trade spats. In previous rounds, 2018 to 2020, everything was about price and tariffs. This time, Chinese buyers told reporters anonymously, "We don't trust the supply will be there if tensions rise again." American energy became radioactive, not because it was expensive, but because it was seen as a political weapon. One executive at a major Chinese refiner summed it up to the Financial Times: "We would rather pay more and sleep at night." The scary part for Washington? China was ready. The Power of Siberia pipeline from Russia was ramping up. Power of Siberia 2 talks accelerated. Central Asian gas from Turkmenistan kept flowing. By late 2025, pipeline gas made up over 43% of China's imports, immune to tariffs, sanctions, or naval blockades. China's own natural gas output hit record highs. Shale plays in Sichuan, tar sands in the west, and coalbed methane all contributed. Moscow redirected nearly all the volumes it lost in Europe straight to China and India at fire sale prices. Solar and wind installations broke global records again in 2025. New coal plants still came online, but utilization rates fell as clean energy took marginal demand. China didn't need U.S. energy anymore. Back in the United States, the fallout is spreading. Export terminals built for a Chinese future sit underutilized. Billions in planned LNG projects delayed or canceled. Shale drillers in Texas and North Dakota face lower prices and squeeze margins. States like Louisiana and Texas warn of job losses and falling tax revenue. U.S. crude exports overall dropped to the lowest levels since 2021. Some barrels went to India, which increased purchases, some to Europe, but no one can absorb China-scale volumes at premium prices. There's a bitter twist. While U.S. fossil fuel exports collapsed, American solar and wind developers are paying more for Chinese-made panels and turbines because U.S. tariffs and restrictions remain in place. Decoupling is hurting both sides, but in different ways. Some say yes, a major diplomatic thaw, new trade deal, or cold winter could restart flows. But many analysts are skeptical. Once procurement teams, shipping routes, and trading desks reorient toward Moscow, Tehran, or Jakarta, rebuilding takes years. Contracts can be revived, but trust? That's harder. And every month that passes with zero trade makes the decoupling feel more permanent. A tanker full of gas or oil isn't just cargo. It's a bet on the future. For a decade, America bet that China would always need its energy. In 2025, China called that bet and walked away. The tankers are still full. The question is, will they ever unload in China again? Or did June 2025 mark the moment the world's energy map was redrawn for good? Thanks for watching this deep dive. If you want more videos breaking down the new geopolitics of energy, trade, and decoupling, hit subscribe and ring the bell. Let me know in the comments. Do you think U.S. China energy trade will ever return to 2022 levels? Or is this the new normal? See you in the next one.